Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions. Monday, June 23rd, 11 a.m. on the East Coast. We are firmly in Cancer for you people that do the zodiac signs. We go from Cancer, by the way, Dan, into Leo. But I think many years ago, since Cancer is obviously a horrible word, although that is part of the constellation, a lot of people look at this as moon children. So moon child and or Cancer. So for you with birthdays, very happy birthday. How are you, Dan? By the way, Carter Worth is in the wings. He'll be joining us. He is not a moon child.
No, I don't even know what you're talking about. You might as well be speaking Greek.
The zodiac, signs of the zodiac. So,
Yeah.
for example, I'm a Sagittarius.
You are a Sagittarius, I guess. I'm a Virgo, and that's all I know here. Yeah, I mean, we're here, June 23rd. It's kind of an interesting time period, Guy, where you think about, end of the quarter. I think you mentioned that on the pod this morning. Sometimes you'll see like some wacky window dressing, that sort of thing. We are in, I guess a quarter that's had probably a really good quarter. I don't know. Let's look at quarter to date, but obviously the S&P is up 2% on the year. And I don't know. Is there much to shake a stick at here? We had that period in April where it seemed like there was enough volatility for the full year. As we get into the summer, are we likely to see just kind of a slow grind once again here? Because it just doesn't seem, if you think about what happened over the weekend, if you think about what's happened over the last week and a half, market participants don't seem to be too bothered about like a kind of new phase in what's going on here in the Middle East.
Not at all. And again, it's that thing. People are not, they're going to wait until something scares them. And, they had a weekend. And by the way, I don't think it's coincidental that these things typically take place over the weekend. It gives the market a chance to sort of digest things. And quite frankly, maybe that's the right course of action. I'm not commenting one way or another, but, people sit back and try to assess what's going on. And, the market says, you know what, worst case scenario didn't take place. There's still a chance that something happens in the Straits of Hormuz. I don't know if that were to happen, but I think the market will price it in if and when, as Carter likes to say. But you said complacency is a word we use. I will agree with that, but this I'll also say. The VIX is still either side of 20, which, is at the lower end of the range we've seen over the last 6 months, but it's clearly the upper end of the range we've seen over the last few years prior. So something's going on here clearly, and I can't figure out one way or another what it's setting up for. But, with the VIX at 20, that's still elevated by historical standards.
Yeah, and I guess the reason I brought up like the quarter end last week was a weird week. We had that Thursday off for Juneteenth, and pretty soon we're going to get into like next week, we have, July. Yeah, towards is that Thursday or Friday?
I believe it's Friday, but
yeah. And I think we have a half day on Thursday. So all of a sudden now you have this sort of setup into quarter end, and then the first week of the new year or the new quarter, the new month, it's going to be like summer trading, right? If you will. So, I guess like really quickly before we get to Carter, because there's still some earnings this week. We know we have Fed Chair Powell tomorrow morning. I think that most folks think there's probably not going to be too much of a difference between what he said at the Fed presser on June 18th. But there's stuff that's happened that is likely to put upward pressure on inflation, which is likely to kind of let him reinforce the reasons and why he is waiting. And, Fed funds futures, we talked about this, they're pricing nothing for July for the most part, but September is obviously in play, and it's always been in play for the last 9 months or something like that. So talk to us a little bit about what you expect after Fed Chair Powell speaks.
Yeah, listen, again, it's the Q&A or whatever happens after his remarks take place is typically the market moving. I think they've been pretty clear, although there seems to be not dissension, but I think there are differing opinions within the group at the Fed, and that should be where we are at this point in the cycle. But I think by and large, they're sort of steadfast that, they still see concerns on the inflation front of things, and they're not in a real hurry to move. And I don't think they should be in a hurry to move. I don't see anything breaking with yields where they currently are. People say they're restrictive and the rest of the world. Well, it's that old thing your mother used to tell you, just because everybody's jumping off the Empire State Building doesn't mean you should. And it's the same thing with rates. Just because the rest of the world seems to be lowering their rates doesn't mean we should either. Things are moving along just fine here with rates where they are. So that's that old saying, if it ain't broke, don't fix it. And I think that's sort of where their head is at right now.
Yeah, a lot of old sayings right there for you, guy. But this
Hmm.
4.31 level or 4.3 level in the 10-year, it's something we've gotten down to now a few times. If you're just looking at that over the last few weeks or so, and again, I mean, your guess is as good as mine. If he remains hawkish, what the 10-year does. We know that when they lowered interest rates last year in September, we saw the 10 opposite way. So who knows? The dollar short little bounce here. Do you think that's something that is going the way of yields at this point? Because that was the sort of disconnect that we saw, back in April, where you saw the 10-year go higher, you saw the U.S. dollar go lower. That was something that kind of freaked out. I think, the White House. That's how that taco trade became, joined the vernacular, if you will. But since then, it's really been a lot of like sideways action, if you think about it, for the most part, I think, in yields. And it went back to selling U.S. treasuries in April and selling the dollar, and that was selling the U.S. trade.
And I think that trade, by the way, I don't think it's going away. I think there are a lot of people that think there's some sort of secular change. I think Peter Bookvar's talked about that. There's some other people that have brought it up as well, that, we've set in motion. I think not people necessarily shorting the U.S. market or the dollar or our bond market, but not buying as much, which probably has a similar effect. It's somewhat nuanced, I know, but it has a similar effect in terms of what it means to all those different things. So I don't think that's going to change anytime soon. And, to a certain extent, we've set ourselves up for exactly that in terms of some of the stances we've taken. And it's not political. I mean, it just sort of is what it is, and we'll see how it plays out. But, Ed Yardeni had a note out earlier. I think this was, or quotes from Ed Yardeni talking about why the markets aren't selling off even after attack. And, we have a little bit of a slide here. We can sort of look at it and talk about the reasons why. But I think a lot of people would have said going into the weekend, if something were to happen, where's the market going to be? And I'd probably be one of those people. But again, it wasn't worst case scenario, and here we are. So either way, oil price and risk off moves are possible, but are likely to fade quickly. And I think that's something, we actually have talked about in terms of crude oil, at least.
Yeah, well, let's talk about crude oil, but let's bring Carter Braxton Worth in, because maybe he can help us make some sense of just the level of complacency. Carter, thanks for waiting. We know that you were dying to get in here and give us your 2 cents about what's going on here in the markets.
Well, it's such a testament to there's no such thing as positive or negative news. It's incredible, right? We're always tempted to think, well, company X raised their guidance from $3 to $4, and they said gross margins are better, and they bought back more shares than we thought and increased the dividend. The stock's down 10%. All those things are good news. Well, obviously they're not good news, because if the stock's down, then those things are bad. People are expecting more. Maybe they expect the chairman to resign. No one liked him, and he's going to stay around for like 10 years. Oh, God, this guy. I mean, the point is, there is no such thing as good or bad news. And obviously, one can't say bombing Iran is good or bad. The market is up, and so the market interprets this as not a bad thing for all intents and purposes. And that's the weighing machine that is the market. I think the real tell is that oil never could really spike. It didn't spike with post-bomb any more than it did when the first attacks started, or exchange of attacks, if you will. And so, that's a big intraday reversal. It only went slightly above the highs of last week. And I think oil is a fade for sure. And you want to bet against it. USO is the vehicle to use for that. But, in many ways, on the year, we have an unch year. And the things that we're winning all along, the number one performing aggregate or index or theme is, of course, gold. The Philadelphia gold and silver miners up 55%. And the single worst thing is still the single worst thing, despite the recent reprieve. The Philadelphia Stock Exchange Oil Services Index down 17%, even with the bump of late. And so here we sit with an unch market. There's the fade in crude, the gap up, the gap fill intraday. And, at this point, pair of twos-ish with the bias to the downside.
It certainly feels that way. And you've said this a number of different times. And, I've brought up the fact that I've been faked out dozens of times over the years in terms of the geopolitical things. But something we've said over the last couple of weeks is what we have learned, what I've learned the hard way, is typically rises in price on the back of geopolitical or anything of this nature are typically short-lived. With that said, let me throw this sort of wild card at you. And I think the parliament voted to close the Straits of Hormuz. I think it needs like the supreme leader or something, or some final vote from Iran to close them. But if that were to happen, does that change the narrative, or is it just sort of a longer duration in terms of the potential to fade something?
Yeah, I mean, there's a question of whether there's an authority to close the straits, and of course, can someone stop them with more boats and more muscle? But I mean, here, once this is what a client wrote this: the bulls, Iran regime change, Middle East is forever safer. U.S. takes all their oil and prospers. Trump resorts in Tehran, everything beautiful, a big, beautiful, bigly peace, a bigly peace. So we'll see. Anyway,
Trump resort
you know.
in Tehran is actually amazing.
Or it wouldn't be Tehran, but it'd be the Caspian Sea, of course.
Yeah.
There'd be, yes.
Yeah. Well, listen, I guess the big fear, and Vice President Vance said it on the morning shows yesterday, that if they were to close the Strait of Hormuz, that would be like economic suicide for them. But this goes back to something where we've talked a lot about this geopolitically. When you have a country like this backed into a corner that is such, like they have such major ideological, philosophies about how the world should work and what their kind of motivations are and who they've been backing, for these proxies, and really the instability that has caused. There's a lot of scenarios you could say, okay, if the near term this thing, works out the way in which the Israelis want to and the way that we want to, then maybe it is a much safer place, and maybe you do see oil flow easier, and maybe you do see a much more prosperous sort of world. Who knows? That's for all of us to guess. So the oil fade is interesting, Carter. You're often a fader of those sorts of moves, whether it's yields, whether it's crude, that sort of thing. And again, it's you use this term. I've been listening to it for 15 years. This guy has a sort of reversion to the mean is a good way to kind of think about how things work in markets, especially when
for extreme news related moves. They're usually knee jerk in nature, and there's some give back or reversion after the initial or 2-3 day spike or plunge. Yeah.
Yep. All right, let's hit. We appreciate you bringing some charts here on 3 of the big earnings we have this week. And again, these are all interesting names. We can glean a lot from what these companies have to say. Tomorrow after the close, we have FedEx, and this is one. Hey, by the way, the founder of FedEx passed over the weekend, and Guy, this is somebody that it was such a straight shooter. He was kind of like one of those sorts of, call him an entrepreneur. When he started FedEx, when he got back from doing 2 tours in Vietnam, he raised VC capital to start this thing, which is pretty cool. Anything that you want to say there really quickly? Because again, these are some of these sorts of, these really innovative sort of CEOs that you don't get. They're kind of like once in a generation, don't you think?
Well, Fred Smith is the gentleman's name. I know you know that, but yeah, absolutely. A visionary without question. And you think about it, what he did, I mean, he is the face of this. And I think he went to Yale. I think he came up with the idea for FedEx when he was a student. And good for him. Only 80 years old, which, sounds in today's world not so old. So a pioneer that we probably, when I say we, CNBC probably doesn't talk enough about, but he lived an incredible life. And I think he was in the Marines for 4 years or something. So just a great American, I guess, is what I want to say. So rest in peace, Mr. Smith, for sure.
Yeah, no doubt. I met him once, actually. This was in 2019 at the Super Bowl. It was at the Fanatics party, actually, and I went up to him, and I just introduced myself. And a good friend of mine who was a Navy pilot, and he still is actually in the reserves. I know that he had a lot of affection for him. I took a selfie with him, and I sent it to my buddy Pete, which he thought was pretty cool. Last thing on the FedEx, you see that? Are you staring at the EX? I learned this in a marketing course years ago. You see that arrow there. A lot of folks don't get that. I mean, Carter, you're good at pictures. You saw that, no doubt about it. Probably one of the first times.
Yeah, part of their logo. I mean, obviously they changed their name, right? It was Federal Express, and they've made, because people shorten things just for the vernacular, FedEx it, and it's become a verb. And that's when you've really got a brand. You Google it, you FedEx it, or you, Kleenex. These are or Xerox it. Verbs. It's or so forth. But I think there was also, before we look at the charts, it was controversial, right, that he was going to ship them all to one spot, right, and then ship them out. I think people rejected that. They said, so if you've got a letter going from Baltimore to Washington, D.C., you're going to ship it to the middle of the country and then send it back? How about if it's on 68th and 3rd and you want to send it to 70th and Lex? And you're saying, yep, I'm going to ship it to Midwest and back. They're like, that's asinine, bad idea, but obviously genius. That's the best things usually are. But anyway, the chart. It's a pair of twos from my seat, but let's look at it. So nothing on this one. Next iteration, we can flash those for fun, take it on, put it off. I mean, so I've written a pair of twos there. I mean, that's kind of a jump ball. We're inching above that downtrend line in affections 300. If you put the 150-day in, I mean, if and as it's going to go higher, I mean, that would be sort of what one might look for. So 240 plus or minus. But I wouldn't play. This is the kind of thing where I would not be directional into the print.
Yeah, I mean, if you look at FedEx, Dan, real quick before we move to the next one, I mean, since 2021-ish, let's call it the middle of 2021, I mean, the stock has been sideways. It's basically been between, I don't know, low 200s and maybe 300-ish, and maybe some extremes along the way. But you wake up today at 225. I mean, this is the same price the stock was effectively 4 years ago. So I don't know what to tell you. I'm sort of with Carter on this one, although – if you look at that pennant formation that we had up, maybe we have a chance we sort of break up and then test that 150-day. But I'm sort of more on the pair of twos camp as well.
Yeah. So one of the things that sticks out to me a little bit was that 240 level. If you're going to go back to the 1 year really quickly, you saw that breakdown in early April, and that had to do with obviously the trade situation. And if there's going to be one company that's affected, from a freight standpoint, I mean, this would be it. And so you look at that next gap that you saw to that downtrend, that was something that got filled in almost immediately, right? And so I just think that's kind of interesting. I think to Carter's point, yeah, there's something's going to resolve itself, but it's probably a bit of a coin flip, especially when you think about the oil spike, you think about the potential disruption, to global trade with what's going on geopolitically, and then you think of like the lack of clarity as it relates to the trade war. So this is definitely it'll be interesting to hear what they have to say. I think most importantly. All right, let's look at on Wednesday after the close. It's Micron. And this is one that guy, we've talked a lot about over the last few years. It seemed like some of the memory makers were left out of this kind of generative AI trade. Then they joined the party, right? Because obviously it takes a lot of memory to go into servers, that go into the data centers, to train the models. A heck of a move of late. Carter, how are you looking at this one into the print? Because this is an expected big move. You saw that about 8.5% in either direction.
Yeah, I mean, talk about volatility, and to some extent, it's schizophrenic. It gaps up, it gaps down, it gaps up, it gaps down. It plunges more than the market. It ricochets. My God, it's doubled, right? 60 essentially to 120. There's nothing here that lends itself to anything coherent, and so I've kind of annotated it that way. If you're long, I would sell calls. I mean, at a minimum, and my hunch would be to trim here, in anticipation of obviously the risk associated with going ahead of the print in a pattern that is unclear.
If you look at it, Dan, like many of these names that we talk about, which a lot of them topped out last summer and then had dramatic declines culminating in April. And a lot of them are right back to those prior highs that we saw last summer. And that's what's happening here in Micron. I think that high, if I'm not mistaken, please don't at me if I'm off, but I think it was about 144 or thereabouts. I think basically that was an all-time high in the stock. As Carter just said, the stock got more than cut in half. It's rallied significantly since then. So maybe you see similar here as what we've seen with a lot of these other tech names, where you take a revisit back to those prior highs we saw last summer. We've seen it with Microsoft. We've seen it with some other tech names. Stands to reason we might see it here as well.
Yeah, it is worth noting that obviously, Dell is a big customer of theirs, and like all the kind of names within the kind of data center. Let's pull up Dell for a second. After its earnings, it really didn't have much of a move. This was kind of in late May or so, and some of the things that they had to say, they told a nice story, about demand, but in a lot of ways, you see that consolidation there. So not particularly impressive, but I'm, again, really interested to hear what Micron has to say and what the reaction is. Guy, we spent a little time on Lulu a few weeks ago when they reported. Was not a great quarter. You could make the argument that, they have some specific issues as it relates to, just sort of competitiveness is really important. But also, I was walking down the street with my wife yesterday, and on this block on Fifth Avenue. There's Lulu, there's Viore, there's a whole host of these things.
Yeah.
And it seems like some of these other brands are really kicking Lulu's ass. Nike is a bit of a different story. But so I'm interested from what they have to say from a consumer discretionary standpoint, from a competitive standpoint, and then also what they're talking about as it relates to China. Guy, thoughts really quickly on Nike before we get to the charts?
Well, a lot of it's self-inflicted wounds, a lot of it in the form of competition. We've talked about, you just mentioned China, and I'll say it again, that's Carter's static chart. But if you want to go to one of ours real quick and look at longer term, I mean, Nike has been a non-performer now. When I say a non-performer, this goes back, Dan, to, I want to say, the fall of 2021, when it probably made its all-time high north of 160 or something like that. And think about it since then. It's been basically upper left, lower right, series of lower lows, lower highs, and that's been unabated pretty much for that period of time. Can it bounce here? Yeah, I guess it can, but there's nothing compelling here. And by the way, you mentioned Lululemon. That made a 52-week low, multi-year low, 2-week low today below 220. So I just think the competition in Nike has just come back to sort of bite them in the ass, and the lack of innovation as well.
Yeah, no doubt. I mean, Carter, we've talked about a lot of these consumer discretionary names over the last, couple years since the COVID highs, and they just seem to be, in favor, out of favor, that sort of thing, but they don't act commensurate to the broader market. So a lot of folks kind of get wrapped up in the fact that, Nike's never traded this cheap in a long time, but it seems like a whole host of the issues that we just talked about are kind of weighing on that stock. So as far as Nike's concerned, the print, also another big implied move, 7.5%. Either direction. It's been moving a lot after earnings over the last few years. You can see some of those big gaps there too.
Yeah, I mean, before we get to the chart, it's we're all prone. I could speak to myself anyway. To you have biases, and you think of a great American franchise like Disney on its knees here, or Nike, and you think, well, this has to come back, or Boeing. The greatest companies of all, General Motors, the most valuable company in the world. It's practically a micro cap. I mean, to be facetious, but you get the point. Exxon is a shell, literally, of its former self when it was the most valuable company in the world, and on and on. U.S. Steel, and so there's no such thing as a growth stock. That is an elemental thing that has to be said. There's simply stocks in growth phases, right? So when you're Alcoa, and you introduce aluminum, and everyone else has got a steel can that rusts, and you have the beans in the aluminum can or whatever the heck it is to build cars. You win, you're growing, you're IBM, then you're not growing. So this was a growth stock, maybe it's not. But to your point, Dan, initially, this speaks to China. It speaks to U.S. consumer. It speaks to things like FedEx and transport and boats and fuel costs. It speaks to consumer trends. Currency involved here as they sell their wares all over the world, or their shoes, if you will. But as to the chart, there is one thing that is clear. It is moving down and to the right. If we were to put that's a pretty well-defined trend line. It's in the middle of the channel if you look at the next iteration. And so what do you do with that? It's kind of a pair of twos at best. There's no premise other than a bias. Well, it's probably cheap here. Or, well, I bet you it's so out of favor, it'll gap up on its news, and I think I'll get low. That can work, but that's not a technique over time. If you were to look at the longer term chart, and this is really quite stunning. I mean, not even Disney's below its COVID low. It's at its COVID low. That is historically bad. Now, one could say that's the point. You got to be bold. The Warren Buffett, be bold when others are fearful, and fearful when others are bold. And this is the moment. I'd rather miss 10% gap up on earnings and play it afterwards. So you look at the symmetry here, up, down, back, and it's just sitting here. Now, at some point, is there some terminal value for this franchise? It can't get any. They are obviously biggest and so forth, but they must be doing something wrong. In any event, and then final chart. This is a comparative chart over the same time frame, and it's just a reversal of fortune. I mean, things go wrong in life. Now, I don't know what their problem is. I have a pair of Nikes or two. I don't wear them every day, but I mean, it is for me. It's just laces and soles, and you put them on and move on your way. But obviously, one day they'll fix it. Is that coming with their earnings print tomorrow or whenever it is this week? Probably not.
Yeah, and I agree with that. I mean, in terms of we've seen this before, and I wouldn't say Nike is specialty retail because that's not fair. But you look at these brands, and they all have their arc. And we mentioned Lululemon's going through it now. You want to go back and look at Under Armour. I mean, they all sort of face the same challenges. They create a space, they dominate the space. Competition comes in, they get lazy, competition laps them, and then you see the other side of the mountain in terms of the stock price, and that's what we're seeing here. Listen, Carter, before we go real quick, this is from Gary Webb, and I don't mean to tee you up, but I know you can answer this. He's asking, which of the major indices do you believe is the most vulnerable to the downside right now? And I guess, probably not only U.S. stocks, but maybe some of these international markets as well. I look at the S&P where we are now, and I look at the NASDAQ. I mean, I think there's a vulnerability there, but clearly not manifesting itself in any way, shape, or form.
Yeah, I would say that's a great question, and you get that one right, and you can manage a $30 billion portfolio, because it's all about, when you're long only and 98% of the capital is, finding where you're overweight and underweight. But if you were to look at the MSCI All Country World Index, X the US, it has had one of its biggest sort of 3-month advances on record. And so that is something that seems quite vulnerable to me. But other than that, as an aggregate, aerospace and defense, GE, CW, meaning that theme seems very overdone.
All right, my man. Well, we appreciate you being here. We appreciate you running through the earnings names this week. Thanks a lot, Carter Worth. You guys know where to find his worth. Go to worthcharting.com. You can have all that information in your inbox every day. Thanks, Carter. Guy, it is worth noting. So what he's talking about, the all world index, the MSCI X US, the equal weight S&P 500, as it's basically in line with the S&P 500. So, we talked about on the pod this morning, it was an article in the Journal over the weekend that, investors are souring on mega cap tech. And we've highlighted the fact that the Mag 7, you still have Apple down 20% of the year. Tesla's having a day. We're going to hit that in a second. But now it's only down, 12% on the year, something like that. You have, Google, there's plenty of reasons why investors have kind of shied away from that one. It's down 12% of the year, and then Amazon down 5%. So that makes some sense. It speaks to maybe a broadening out. You and I, we use that term. That's something that a lot of other folks use, but you see when the Mag 7, which is, if you think about those, throw, a Broadcom and one other in there, they're making up 45% of the weight of the S&P 500. But, Yeah,
I was just going to say real quick, throw an Apple chart up, because here we are at sort of either side of $200, underperforming today. It's been an underperformer now for quite some time, made the all-time high north of 260, and like everything else, cascaded lower into April and bounced. But the bounce wasn't nearly as robust as some of these other stocks, number one. And then the recent action has been mediocre at best, probably less than mediocre. And you juxtapose this with, I don't know if Jacob or Stephen can do this, but put a Microsoft chart, just juxtapose a Microsoft with Apple, and just see the relative outperform. I mean, it's like night and day difference what's going on over that same period of time. So I just point that out because there's clearly something going on with Apple here that I don't think the market's paying enough attention to.
Yeah, over the weekend, there was some I think this headline just kind of highlights just how far behind they are as far as integrating, generative AI tools into iOS, and then obviously on their devices. And, they were talking about that they may buy a company called Perplexity. It's a company that we've talked a lot about on the pods. It is not a company that's built large language models like that of OpenAI that has ChatGPT. But they compete with ChatGPT as like a search engine, or as an answer engine, as they like to call it. Now, if you go to Perplexity and you pay $20 a month for Perplexity Pro, you can choose between ChatGPT and OpenAI's large language models. You can use Anthropic's Claude. You can use Sonar, which is a model that Perplexity is working on. You can use Grok. So to me, that is my chat bot of choice, because you have the choice of all those other models. And I like what they're doing with the user interface. We've been saying this for a while, and we had Arvind Srinivas, the first time he was ever on CNBC. This was in February of 2024. He is the founder, CEO of Perplexity. When Apple did not have a strategy at all, we were like, this makes so much sense to kind of put this on or integrate it into iOS. That was when the stock was, or the private market value of this company was $2 billion. They're raising at $14 billion right now. And the Journal article was basically suggesting that they may pay $15 billion for this company. I think it would be a smart move. I thought it was going to be smart at $2 or $4 billion last year. But the reason why this stock has been acting the way it has is that investors are like, listen, they got nothing. and they're going to have to compete with these other smartphone makers, these other device makers that are going to be using OpenAI or Google with Gemini and the like. So again, that's why Apple is underperforming, and we get it. Where do you want to go next? We got to.
Well, I mean, you mentioned we have a call today that will get us into sort of what's going on with Uber, then into Tesla, because I think that is sort of interesting. So let's look at the call of the day real quick.
Yeah, so this is Raymond James on DoorDash. This is not a name that you and I talk a whole heck of a lot about, but there's a Deliveroo. This is a European delivery company that they're going to be merging with, and so this company, Raymond James, is kind of taking a look at the deal. They think it's underappreciated. Investors right now don't think it's underappreciated. Thoughts here on the DoorDash, because one of the knocks on this company for a while was that they're competing with the likes of Uber, and Uber Eats was basically out of the gates a big winner. But look at where this stock has gone from, Guy. I mean, it's up more than 100% on a one-year basis.
If Carter were here, he's not. I mean, but this is one of those bearish to bullish reversals, and obviously there's not a lot of history in terms of how long this has been a publicly traded company, but since 2000, in the fall 21, when it probably made its all-time high. Then you had this really large move. It sort of had this little rounded bottom all through 2023. Now it's back on its horse. I mean, it stands to reason that we can get back to those prior highs. Today was a 52-week high. I think the all-time high, as I mentioned, is probably north of 250 or right around 250. And then we'll see what happens when it gets there. But to your point, I mean, a lot of this move has already taken place.
Yeah, and it's worth noting that one of the knocks on these companies was that the unit economics were really bad, and there was a lot of competition, whether it was Uber Eats or Grubhub or DoorDash, and they've gotten a lot better. And I'll just kind of highlight this a little bit. So, adjusted earnings in 2023 were $1.80 for DoorDash. Then they were $3.19 in 2024. They're expected to be $3.99 this year. The stock trades like that consensus is a bit too low. Next year, consensus is for 558, and then you see a deceleration on the revenue front. You're expected to have 20% revenue growth for the next few years or so, and margins which have been increasing a little bit, Guy, in the throes of the pandemic. And this speaks to, they basically had a lot of demand, 52%, but then they got killed. They went down to 45.5. Now they've been going higher, 47, 50, expected to be 51.5 this year, and then 52. And that's the sort of direction that you want to see in gross margins. But the stock trades on this year at 57 times and 41 times next. That's where you probably come up against it a little bit from, just a valuation standpoint.
Agreed. And that's why I think there's a very good chance of given this move and given that valuation, you get to those prior levels and stall out. So we'll see. I think this is sort of late in the game for an upgrade. But the name that everybody's talking about today, Dan, I don't want to bury the lead, but, robo-taxi has been a theme. Well, Tesla getting people excited again around the robo-taxi thing. Dan Ives has talked about it. You mentioned to me this morning, Dan Ives actually went down to Austin, Texas for this. Good for him. And people are all jazzed up. It's manifesting itself in the stock move today.
Yeah. And the fascinating thing, and Dan was on the pod, the Reversal pod last week, and he's been coming on a bunch, and I really appreciate his commentary. He's been an Uber bull in Tesla. He's never really wavered except during the trade sort of situation in April. And he said, listen, this is a big, huge threat for them, because it's not just the trade situation. It's not just the competition by the Chinese. It's also the fact that these credits, whether they be to consumers, are likely to go away in this trade bill, and then they're trading of these emissions credits. They make a lot of money on those. It's just margin, right? And so one of the things, though, that this company, their EV business is really bad right now. They're expected to be down this quarter 14% in deliveries year over year, right? They're going to have a huge decline on an annual basis. Their margins have basically gone away. They're buying down rates here. So a whole host of problems with their EV business, but they've been pointing to robo-taxi. And that's why the stock today is up 10%. Now, I don't know why. They got 5 of them in Austin, right? Like, think about this, right? And they're charging $4.20. That's really funny, Elon. $4.20. You all get what's going on there, right? This guy, I guess he's puffing a lot of the Magic Dragon there, Guy. But I know that's not something that you've ever participated in. But that is funny. $4.20. So stock's up 10%. You know, they're going to report deliveries in about a week and a half or so. And that's what, in my opinion, the stock should be trading off. It shouldn't be gaining $100 billion in market cap today because they got 4 robo-taxis out in Austin. So to me, I mean, you tell me, is that rational price action or is it irrational price action?
No, I mean, look, there's nothing rational about a lot of the things that we talk about in terms of the broader market and individual stocks. I mean, rational in terms of technically that we traded back down to the basically 200-day moving average or so, you know, either side of it now ratcheting through. That's been sort of this line of demarcation. Is that rational? Yeah, maybe. I guess it's somewhat rational. But if Stephen quickly wants to just draw a horizontal line and do it across the chart, I mean, you'll see this level that we topped out at, I want to say back in February, and then again a few weeks ago. I mean, here's your line in the sand if you want to draw the horizontal line, and you can see we've stopped here a couple different times. And this, by the way, the level where it's sort of trading at now is basically a 50% retracement of the entire move from the all-time high we saw earlier this year to this recent low that we saw a few months ago. So this is your level. I mean, you can pick and choose. You can say we're gonna just sort of ramp right through these levels and we're off to the races again, or you can be in the Dan Nathan camp and say the fundamentals don't really make any sense here, nor do the some of the metrics that we talk about, and you sell it at this level. You know, I'm hard pressed to understand, to your point, though, why the stock is up as much as it is today.
Well, listen, if you are long this stock for anything other than a trade, you believe in the long-term vision of Elon, you believe in this kind of transition away from just EVs to robo-taxi. If you think that a successful robo-taxi service from Tesla is going to cause demand for their, you know, cars before they ever get to Cybercab, which will be a separate sort of situation. I mean, they're basically trialing this on their Model Ys. And so if that's something that's going to cause huge demand because robotaxi is going to be a great business, whether it's somebody who owns a car and puts it into the fleet, or whether it's somebody who basically ends up, you know, buying or holding fleets of these sorts of things. You know, one of the issues that I have is that, you know, Kathy Wood is talking about this being, you ready for this, a $5 to $10 trillion addressable market, and specifically what Tesla can take. So to me, that doesn't make a lot of sense, but it is what it is. And you got to be very careful. You don't want to be stepping in front of this. I've been very, very cautious on the name, on the fundamentals, not been short. This is not a stock. Look at what happened. It doubled from, you know, election day to late December. That didn't make a whole heck of a lot of sense. So it is what it is. Really quickly on the Uber, and this is where we wanted to go. You know, Uber has been adversely affected by positive sentiment as it relates to Tesla's robo-taxi for obvious reasons. So what do you see here? Huge ramp from those April lows. I think a lot of bulls on Uber guy don't think that Waymo and robo-taxi from Tesla are going to be something that is, you know, in the forefront here for Uber, but it's one of those things that it's been a little weak as there's been a lot of talk about this robo-taxi launch.
Yeah, well, we recently saw an upgrade in Uber. I think it was a week or so ago, week and a half or so ago. We addressed it on Fast Money. The Waymo news we've heard before in terms of the life cycle of Uber, and we've seen sell-offs before on the back of it. Uber to a certain extent as well. I don't think it's an existential risk at all, and that's just my opinion. I think both can live, and I still sort of like Uber here. Now, obviously, today's not the day to be saying that. Stock's down around 80, 81 or so, lowest we've seen in a bit, but I you know, Uber's the you in my tube, as you know, and I think you can make a very compelling case that, you know, Uber's sort of at the pole position, no pun intended, in the space, regardless of what Tesla or Waymo does.
Yeah, so this is 2025, right? That's the year this is in. You know, back in 2021, guy, remember meme stocks were a thing, meme coins, meme everything. And that was obviously, you know, one of the signs of the highs in the market for at least you and me and our main man, Danny Moses, as we were thinking about it, you know, late 21. But here's a stock that's been a meme stock in 2025, and that's Hims. This is the Hims and Hers. They kind of caught a bid on some of the deals that they were doing on the weight loss drugs, the GLP-1s. And let's go to a one-year chart for a second here. Today, the stock's down 30%. the Wegovy maker, that's Novo Nordisk, which has had a difficult time, especially as they've been competing with not just Lilly, but a whole host of other upstarts. They canceled their deal with Hims and Hers, which is a lower cost direct to consumer sort of product that they've been talking about, because Hims and Hers, the reason why they were able to kind of get into this market was using these compounded drugs. And then a lot of investors got excited about when they were doing a deal with the Wegovy maker. So this was a higher quality, sort of GLP-1. So Novo, they're canceling it. They don't like the what they think are just kind of bad advertising practices, because they're still offering some of these compounds. Thoughts here when you see a stock down 30% one fell swoop, guy?
Well, I mean, that just goes to show you. I mean, by the way, you've seen it before with this name. You want to go back to like earlier this year. I think it was, I want to say it was a $70 stock, and you see what happened into the spring. You see the subsequent move back to those highs, and then you saw the sell-off in early May, and now here we are doing the same thing. I mean, if there is any such thing as a triple top, Hims and Hers seemingly has made it, and it's one of these names where momentum works both ways. You can't make a compelling case on valuation, and you're talking about, I don't want to say complete existential risk, term I used before, but again with Hims and Hers in terms of this Novo thing, but it clearly doesn't help. So I don't think it's over today. I would avoid this for a while. I think there's still room to the downside.
Yeah, and it's interesting that, Novo is pulling the plug on a retail channel. And just pull up Novo Nordisk for a second here. Look at this thing, guy. Got to that downward trending moving average, got rejected there, I want to say a week and a half ago or so. And so when you see a company make a move like this and they know it's going to hurt their sales channel, that's really interesting to me also.
No doubt about it. And, I thought Novo was out of the woods. Clearly, I was mistaken in that one. And, it seems to be what was a two-horse race in the form of Lilly and Novo Nordisk a year or so ago has turned into sort of Secretariat and everybody else in terms of what Lilly's doing to the competition.
All right. Last thing, tomorrow we have a very special edition of the Market Call. Our main man, CC Lagater, who is our team member, he writes our daily newsletter. He's going to join us. He's been working on something for years, a really cool options trade, creator, if you will. And obviously it does a lot of other things there. That's the options AI. He's going to be joining us tomorrow at the end of the Market Call. We're going to go over, how to use that tool to construct some trades. We're actually going to put some trades on some of these names that we've been talking about today, maybe some of these earnings names, and kind of help you think about what the options market is pricing and ways to kind of express your directional views. So that's going to be tomorrow. So make sure you tune in for that, guy.
Big week ahead in the risk reversal media world. That's it, today's Market Call. But as Dan said, we'll be back tomorrow. We'll see how this market shakes out, sort of giving it back over the last few minutes, but still a lot of day left, Dan.
All right. We'll see you all tomorrow. Thanks so much.